Howdy, Jacob here. Today we're looking at Viper Energy, ticker symbol looking like VNOM. Pretty cool, pretty cool. $5.5 billion market cap on just under $6 billion enterprise value. It's in the oil, gas, and consumable fuels industry. Very new company, founded in 2013. It owns, acquires, and exploits oil and natural gas properties and is a subsidiary of Diamondback Energy. They've grown crazy. Like I said, it's a very new company, but tenfold revenue from 2014 to 2022. Return on invested capital is fairly subpar, probably averaging out low single digits. So that's not great to see, but again, makes sense why they're paying a dividend. We see 5.7% dividend yield, pretty good yield. Let's look at this debt here. So $577 million long term debt and 18 million on cash flow. That is tough. That is tough. That is a not liquid asset portion of their balance sheet with quite a bit long-term debt. But let's see what the 5-year average free cash flow looks like. So 5-year average is all over the place. Okay, so this will be interesting. It's as high as $749 million, but as low as almost $370 million in negative free cash flow. 377 million, 379 million negative free cash flow. I guess this one's even 200. Okay. So their payout of 295 million, which is 5.7%. On a 5-year average basis, they cannot afford that. So that's why they've been issuing debt and shares here and here until they've started making a lot of money. I mean, this is just an interesting thing because I'm using averages here, but the company's so new that I want to wait more on their new business, but also the price of oil and natural gas from inflation has been a lot higher recently. And so I'm probably going to take a balance of probably going to lean heavier towards the more recent information, but also remind myself that inflation has really bumped those numbers up. And I don't know if I can expect those margins going into the future. But I think I'm ready. I'm ready to make some assumptions here. We see that revenue's grown like crazy. I just don't know the sustainability of that. It just seems to me like it's grown so much so fast. There might be some plateauing and then some regrowth in the future. So I might say a 2%, 13 on the PE price of free cash flow, saying that it might be flat or might go down in the short term. But then again, we're looking at a 7-year period. Maybe in the 3 to 7 year period, it'll increase at 3 to 6% or so, and then at the end of year 7, although it's likely a cyclical business, they'll still have some growth ahead of them because they're so new. As for margins, again, just taking some averages here because it's really all over the place. Say 25, 20 share changes. They've increased shares quite a bit, actually. And then the dividend, they can afford it with their current free cash flow, but on an average basis, on a 5-year average basis, it's only 50 million. And so, I mean, I'll say that they cut it in half, and it's still $150 million payout. But before I do more research on it, I think I'm comfortable with that. And that still gets us to a price point that needs to fall 52% before we get a 15% return, given these assumptions. I mean, it's a newer business, and when you make assumptions like this, it's so much easier. The more data, the better. The more consistent the company, the better. And this is just such a new company. It's grown like crazy so much recently that I just don't. I don't feel entirely confident in these numbers per se and how accurate it is before looking at something. But given what I have, I made the best with what I had, and right now it's saying that it needs to fall quite a bit before I get the return that I'm looking for. And so probably won't be researching it for a little bit, but I hope everyone enjoyed the video and has a great rest of the day. Thank you.